Hello everyone, hope you're doing well. Welcome back to the channel. Today we're going to be talking about the stock market volatility that's happened over the last couple weeks, and especially this past week, and why I believe there's probably more to come. Let's take a look at some of these charts the last little while. You can see how the last few weeks have shown really pretty steep increases and decreases. I mean, these in-betweens will mark between openings. You can see it's pretty, throughout the day it's a little choppy, but between each opening day, it's all right. Some of these are a little up, but you can see starting, the last week and a half, you're starting to really see some big changes from day to day. Not even just intraday, but even day to day. And you can see that really be exasperated throughout the past week. Like, look at this incredible up and down lines just all throughout the week. And that's some serious market volatility. So you can see the chart's really choppy on both the increases and the decreases. And if we look at something else that's probably even a little worse, which is the NASDAQ recently, this is, quite a bit worse than the last one. You can see between each day almost, you're seeing big step decreases, some a little step up increases. But you can see really the last couple weeks here, or especially the last week, some really big volatilities up and down. Now, for anyone that started investing the last 10 months, it's really important to stress how outside of the norm these past 10 months have been. If we scroll back here, let's go to a year. The past 10 months is basically starting from April, May, all the way till now, right? And if you were lucky enough to buy, pretty much any stock, and if you were even a little luckier and you decided to go all in on technology, which, would have been held under the NASDAQ, you would have easily seen 40% gains, probably 80 to 100% gains, and for some people, even more, right? Now, unfortunately, this type of performance is likely only going to happen once or twice in a generation. So it's really important to keep that in mind. There was a perfect recipe of an incredibly fast and steep decline back in March. I mean, look at this. From February, March, April, you're talking 20, 30, 40% easily, right? And on top of that, you had central banks around the world, not just the US, printing trillions and trillions of dollars. So if you were someone that was lucky enough to have some disposable income to invest, this would have been the perfect storm for you. And I know this information might sound a little disheartening, or it might sound discouraging when you start seeing your portfolio start to perform more normally, right? If we go take a look at the year to date, potentially maybe people had thought that this year would be another year where they would be seeing great returns. If we look at even just the beginning of the year, January 4th, 12,600 up to 14,000. I mean, that's almost a 10% gain in roughly, 2 months, right? So it's recently started to correct back a little bit, and we'll talk a bit about why, I think that is. But what I wanted to really, stress is 6 to 8% a year is really more than enough for anyone to still hit their goals at a young enough age where they can retire and hit that financial freedom mark, well before the 65-year-old time frame. And I think it's important to bring this up because it's for certain that a valuation reset will likely happen in the market sometime in the future. Is it going to be a month from now? 10 months from now? No one really knows. And I don't think anybody would be able to really tell you. If there's someone that can pinpoint a date in the future when they believe a market correction will happen, I think you should make a bet with them, as it'll probably be the easiest money you've ever made. But what's for certain is there will be a valuation reset sometime in the future, and part of that will be a cause of rising interest rates. Now, there's the phrase no pain, no gain, and it's the same for the market. With low risk comes low potential of rewards, and with higher risk comes higher potential of rewards. So when the central banks around the world lower interest rates due to deflation of the market back in March due to COVID, which means that things are actually getting cheaper due to an extreme reduction in demand, people start pulling their cash out of savings because it provides no rewards. Now take a look at this extremely professional artwork. For example, if you take a look at the market as a whole, say you've got this pie chart where you can get 3% yields, all right, so a few years ago. And you can get a 3% interest rate in your savings account, meaning that if you had $1,000, the bank would then pay you $30 for keeping $1,000 in there every year. And let's say, just for numbers and hypothetical purposes, that at the 3% yield, it's roughly a 33 or a 1/3 split between people that are willing to do equities, meaning 100% in stocks, people that are willing to do a mix, so maybe 50-50, 40-30, 40-60, 30-70 split, what have you, and people that are still not, they don't believe in it, so maybe they go 100% into the savings account or GICs, right? Now, what happens when this 3% interest rate drops down to 2%, to 1%? Well, it's very likely that you're going to see things start to shift around, right? What you're going to see is you're going to see people with savings accounts, people that originally thought 3% was enough for them. They don't have to risk that 3% to go into the market. If 3% goes down to 2%, down to 1%, they might start going to the mix. They go, you know what? I have all my cash and all my savings in this 3% yield, but now it's down to 2%. Now it's down to 1%. I'm not getting enough. My money is not working hard for me enough. So maybe they start to go to mix. Maybe they start taking 20% or 30% of their cash or GIC position and they put it into equities. And the same thing, you're going to have the mixed people. They might start putting even more or all of it into equities. And what do equities people do? Well, they actually might start going on margin, meaning they might start, because they're so confident anyway, and they have their appetite for risk is so high that now that the interest rate is low, they can borrow money significantly cheaper than before, and so they'll actually borrow money to invest. So equities people might now start utilizing. And the two most common things that people know to invest in once they have some available cash is usually the stock market or real estate, which is also extremely hot right now. Furthermore, it's also now got that snowball effect. As more and more people pour money in, you're going to see other people that are not invested start to experience FOMO, right? They're going to have that fear of missing out, and then they're going to start putting some of their money in. So it's a huge chain reaction. But then what happens when you go the opposite, right? When 1% interest rates start going back to 3% or 2%, you're going to see that correction where people start pulling their money out. And when people start pulling their money out and start going back into savings, you're going to see what gets hit the hardest is usually the highest, or the stocks at least, that have grown the most, because usually those stocks have grown the most in both stock appreciation price and the company itself. Once people start pulling money back, you're going to see that growth start to stagnate, right? Some of these companies, like the ones I'm invested in myself, where they've grown 60%, 80% revenue year over year, or 100% year over year revenue. When people start pulling their money back, then those growth rates start to slow. And when those growth rates start to slow, you're going to see the stock price really start to come down. We can take a look at how this has happened already. If I pull up a chart here of any of the stocks that have recently grown a ton, even some of the ones that there's real high conviction in, take a look the last month. This is Teladoc Health. Last 6 months, you can see, although choppy and volatile, it's had really good growth, right? And if we pull that back to a year, it's had even better growth. We're talking, $135 roughly about a year ago. At its peak, it was about $290. And there's been a steep pullback since the last couple weeks, right? And so all of these are factors, and all of these are things that you can see happen real time when certain other economic factors hit the globe. And you're seeing that right now with interest rates going up. If we take a look at interest rates, you can see here, starting from, back in March of last year, it came down and it started trading roughly within a range of this 0.6%, let's call it, up to this spike of maybe 1%. And that was kind of the deemed acceptable range that the stock market was ready for and what people thought would happen. But then it climbed above 1%, and you started getting some market volatility back in early to late January. And recently it's really taken off. And because it's recently just continued to take off, We're up now to about 1.4, 1.5%, even at just a little above 1.5% just a couple days ago. And you can see how that's directly correlated to what's happening in the market. Now, the other factor for why markets are pulling back and you're seeing some volatility is, remember when we said if rates go down, people with equities would now start to use margin. And remember, margin is basically just borrowing money to invest. So when you have a stock brokerage account, the bank or the financial institution that you're dealing with will likely give you some form of margin to play with. So if you have $10,000 cash in there, they might give you an extra $5,000 or $3,000 or whatever the contract is, and they will charge you interest and you can invest that extra money, right? So if we take a look at margin in the US right now, look at how margin has completely grown here. Back in 2016, you can see 474 billion up to 529 billion, which is an increase, obviously. So as the market goes up, people start to get more comfortable and the rates were coming down, right? And it peaked at about 665 billion. But what is important here is you can see year over year, the trend from year to year when it comes to margin, whether it's increasing or decreasing, is usually pretty calm. But you can tell here in 2020, this big dip, obviously because of COVID, and it has completely shot through the roof. And it's trending that way, right? If this chart pulled into 2021, you'd likely see that this margin debt tracker is even higher than it is, end of December 2020. And so what that tells me is that there's a lot of invested money in the market, but there's a lot of invested in the market that's used with debt, which is another direct reason why when interest rates go up, a lot of these people or institutions or what have you that use to borrow money to invest are going to want to take that money out of the market because now their risk has gone up. Instead of paying 0% or 0.5% to make money in the market, now they might have to pay 1.5% or 2.5%. So when you start increasing the cost, that's when people have to start pulling out their money. And since there's more borrowed money than ever before, it's likely that more money will come out of the market than ever before. So all of these factors are going to result in a big market valuation reset. And like I said, it could be a month, it could be 10 months from now, it could be 3 years from now. The more this trend stays, the more of a shift it'll be when that reset comes. But certainly it will come in the future. Which begs the question, what do you do? Well, if there's one thing that we've been talking about and that's stayed consistent video over video, it's that we're investing in the company. That's what we're doing. We're not investing in the market. We're not investing in current market conditions. We're not trying to play the short term. What we've been trying to do is find good companies that have great management, that will make a positive change in the world, that will be players in their fields in the long term, and ideally the biggest player in their field for the long term. And we're investing in them to hold, not for the next 6 to 12 months or 24 months, but for the next 5, 10, 15, 20 years. I'll let the queen of investing right now, Kathy Wood, talk about her strategy.
Actually. And so what we've been doing for the last 6 months is expanding the number of names in our portfolio. And we do that as a bull market extends, because in some ways it's a tax efficient strategy. What we will do during a correction, especially a severe correction like the coronavirus crisis presented, we will sell names which are creating losses now because, again, we've bought them, we've diversified and bought them more recently. Sell those names creating losses to buy our highest conviction names.
So what she's talking about here is basically when she had her core group of highest conviction companies, she has since then bought other companies as the stock market has run up. And when there is a correction in the market, such as perhaps the last little while here, the last couple weeks, she'll start selling some of those names and they'll be sold at a loss because they were bought more recently. And she'll move that cash into her highest conviction companies. For example, for ARK, it's definitely going to be Tesla, Baidu, and you can actually see all their trades on ARK Invest. She actually posts them out daily after the market close, which is really fascinating to see. But that's exactly what I think is a great strategy and what I would do, right? When there's a severe correction, such as last March, or there's a valuation reset, if it's upcoming in the future, what I'll be doing is I'm going to stick with the good companies that I have the highest conviction in. For me, that's probably going to be like a Teladoc, a Pinterest. I'm starting to come around on Tesla a little bit. So that's kind of the strategy for what I would do in a stock market reset. Because going back to what I just said a little earlier, what we're doing here is we're trying to find good long-term companies to invest in. If there's a reset, there's no truer statement than buy low, sell high. And it might be tough to do emotionally when you're seeing the funds start to drop 30, 40, 50, 60% even during a market reset. And these corrections can sometimes last 6 to 12 months or maybe even longer. So it's really important to have that plan in place and really stick with it. As always, leave a like if you enjoyed the video or comment if you have something to say. Hopefully subscribe and share with those around you so we can all get a little more financial literate. And I will catch you next time.